Hey everyone, welcome back to Corporate Decoder, the place where we decode the money secrets of the corporate world and find the stories hidden in plain sight. Today we are diving deep into a financial prospectus for Oaktree Diversified Income Fund, Incorporated, also known as ODIFI. Its Class D shares are traded under the ticker ODIDX, and Class T shares under ODITX. Get ready because this isn't just a prospectus, it is a masterclass in managing income and risk, with a healthy dose of Oaktree's signature credit platform strategy. Stick around to see what that really means for your money. And hey, if you appreciate getting straight insights from these filings, make sure you subscribe. We also have a Discord community linked in the description below, where we break down these complex documents every week. Alright, so what are we looking at here? This is a prospectus dated the 10th of October 2025 for Oaktree Diversified Income Fund Incorporated. This document is essentially the investment roadmap for the fund, detailing its goals, how it plans to achieve them, and most importantly, the risks involved. Think of it as the user manual for potential investors. And today, we're going to highlight the most critical chapters. First off, the fund itself, Oaktree Diversified Income Fund Incorporated, or ODIFI, is a closed-end investment company. That means it issues a fixed number of shares and it operates as an interval fund. This interval fund structure is key because it offers shareholders quarterly repurchase offers, providing some liquidity, but we'll get to the nuances of that later. It is not exactly the most liquid investment out there. Their main goal is pretty straightforward: seek current income and attractive total return. Sounds good, right? But the devil is in the details of their strategy. The fund plans to do this by investing globally, including in emerging markets, in what they call high conviction opportunities. These opportunities are found across Oaktree's performing credit platform. This involves a wide range of investments: high-yield bonds, senior loans, structured credit, emerging markets debt, and even private companies that aren't publicly traded. Oaktree's approach is described as holistic bottom-up proprietary research. They're looking for those special opportunities that their expert analysis uncovers. Now, about that interval fund structure, as mentioned, they offer quarterly repurchase offers. This is to give shareholders some way to get their money out. However, they're only offering to repurchase between 5 and 25% of outstanding shares at net asset value at each offer, and they currently expect to offer at least 5%. This is critical for understanding the liquidity of this investment. The investment advisor here is Oaktree Fund Advisors LLC, which is part of the larger Oaktree Capital Management Group. As of the 31st of December 2024, Oaktree was managing a massive $202 billion. That is a lot of capital, and it gives you an idea of their scale and experience in the credit markets. Let's look at the offering prices and how much actually gets to the fund. Class D shares are offered at net asset value, meaning no front. End sales load, pretty good. However, Class T shares come with a maximum sales load of up to 3%. So if you buy Class T shares, a portion of your initial investment goes towards sales charges. Now, for the ongoing expenses for Class D shares, the total annual operating expenses after fee waivers are around 3.45%. For Class T shares, it is higher at 4.20%. This includes management fees, distribution fees, interest expenses, and other operational costs. These ongoing fees can significantly impact your returns over time, so it is important to keep them in mind. Let's look at the example shown for a $1,000 investment for Class D shares. Over 10 years, you do expect to pay around $374 in expenses. For Class T shares, that number jumps to $455. This difference might seem small, but compounded over many years, it adds up significantly. It highlights the trade off between potentially paying a sales load upfront for Class T or dealing with its higher ongoing fees compared to the lower cost of Class D. Now let's talk about the risks. This is where we really see what investors are getting into. This is a big one. The fund shares are not traded on stock exchanges. There is no active market for them, and they don't expect one to develop. This means selling your shares might not be easy or quick. If you need quick access to your cash, this is likely not the investment for you. The interval fund structure with quarterly repurchase offers, combined with the lack of a trading market, makes these shares pretty illiquid. This is a crucial point about distributions. They might be funded by using your initial investment money or by borrowing. This is called a return of capital. While it means you get paid, it also means less money is working for the fund's investments, and it can reduce your overall capital. Leverage is mentioned quite a bit. The fund plans to use borrowing like bank loans and credit facilities to increase its investment power. The idea is that if the returns from these borrowed funds are higher than the cost of borrowing, it magnifies profits for shareholders. However, as with any leverage, it also magnifies losses. The filing states they can borrow up to 33 and a third % of their total assets, and if they issue preferred shares, that could go up to 50%. Look at this table illustrating the effects of leverage, with invested assets leveraged at about 20.32% and an interest cost of 6.95%. If the portfolio has a total return of negative 10%, the common share total return drops to a negative 14.32%. That is a magnifier effect. Conversely, a positive 10% portfolio return translates to a 10.78% common share return. It really shows how leverage amplifies both gains and losses. Let's dive into the expenses again. The table here breaks down the costs for Class D and Class T shares. For Class T shares, you see a 3% maximum sales charge on purchases and a 1% maximum deferred sales charge. Then you have the annual operating expenses. For Class D, it is 3.46% before fee waivers, and after waivers it is 3.45%. For Class T, it is 4.21% before waivers and 4.20%. After the expense cap agreement by the advisor to waive fees until at least the 30th of April 2026 is a good thing, helping to keep costs down. But remember, these waivers can be recouped later, as long as it does not exceed the expense cap. Flipping to the financial highlights, we see Class D share performance. For the year ended the 31st of December 2024, net asset value began at 8.888 and ended at 9.15, resulting in a total investment return of 12.11%. In 2022, however, net asset value dropped from 9.94 to 8.59 with a total investment return of negative 7.03%. This shows the volatility that can occur. The net assets also grew from 151.7 million in 2022 to 292.6 million in 2024, showing some growth in assets under management. Going back to the strategy, they reiterate their objective, current income and attractive total return by investing globally in high-yield bonds, senior loans, structured credit, and other credit instruments. They also have an 80% policy, meaning at least 80% of net assets plus any borrowings will be in credit-related investment. They aim for a short average portfolio duration, usually between 1.5 to 3 years, which can be negative at times, potentially benefiting them in rising interest rate environments. A key part of their strategy is also an all-weather investment approach, informed by Oaktree's contrarian investment style, prioritizing downside protection and patience. They believe their distressed debt investing experience helps minimize downside risk. The risk section is extensive, and for good reason. Leverage is a major theme. They explain that using leverage magnifies investment, market, and other risks. It can cause the fund to lose money and magnify any losses. If the returns from leveraged investments don't cover the cost of leverage, the fund's return will be less than if it hadn't used leverage, reducing distributions to shareholders or even returning capital. Emerging markets risk is also highlighted. Investments in these markets come with greater risks than domestic or developed country securities, including political instability, less liquidity, higher volatility, and currency risks. The risk associated with collateralized loan obligations or CLOs and other asset-backed securities is complex. Cash flows are split into tranches, with the equity tranche being the riskiest. Even senior tranches can experience substantial losses due to defaults, unexpected collateral issues, and general market aversion to closed securities. Convertible securities generally offer lower yields than non-convertible ones, and their market values can be volatile with interest rate changes. Dilution can occur if the issuer does certain corporate actions without adequate anti-dilution provisions. This is an important one. The advisor and its affiliates are involved in many financial services, and their interests might conflict with the funds. They might provide services to other funds with similar investment programs, and aren't obligated to share opportunities with this fund. This means they could compete with the fund for investments. Now, focusing on the management structure, the board of directors oversees the fund's affairs, with officers handling day-to-day operations. The board is made up of primarily independent directors, with committees like audit and governance. The core of the fund, S management, is the management agreement with the advisor. The advisor receives a monthly fee at an annual rate of 1.25% of the fund's managed assets. The agreement includes provisions limiting the advisor, S liability to cases of willful misfeasance, bad faith, gross negligence, or reckless disregard of duties. Importantly, the advisor has contractually agreed to waive or reimburse expenses, capping total annual fund operating expenses after waivers. For Class D shares, this cap is 2.10%, and for Class T shares, it is 2.85%. This arrangement is in place until at least the 30th of April 2026. Looking at the advisory fees paid for 2024, gross advisory fees were about $3.89 million. After reimbursements, the net advisory fees paid were $3.86 million. This shows how the expense cap and waivers are working to reduce the actual fees paid. This table shows director ownership. It is interesting to note that for most directors, the dollar range of equity securities held in the fund itself is listed as A, which means none. This is pretty common for independent directors to avoid direct conflicts of interest, though some hold securities within the broader fund complex. On distribution, Class D shares are generally for investors like pension plans and corporations, while Class T shares are primarily for retail investors through broker dealers and may come with sales charges and annual distribution fees. Revenue sharing is a common practice where the advisor or distributor makes payments to broker dealers for various services, promotion, or incentives. While these payments don't directly impact the purchase price for investors, they can create incentives for intermediaries to promote certain funds over others, so it is something investors should be aware of and inquire about with their financial advisors. Finally, the interval fund structure means quarterly repurchase offers. The fund must offer to repurchase at least 5% and up to 25% of its outstanding shares at net asset value. However, if an offer is oversubscribed, shares are repurchased on a pro rata basis, and shareholders might have to wait for the next offer. This reinforces the illiquidity aspect. Shareholders should consider these shares an illiquid investment suitable only for the long term. Now for my take on Oaktree Diversified Income Fund Incorporated. This fund clearly targets investors comfortable with credit markets and seeking income and total return. The Oaktree brand brings significant expertise in this area. The leverage strategy is a double-edged sword. It can boost returns but also magnifies losses dramatically, as seen in the example table. The illiquidity of the shares due to the interval fund structure and lack of a secondary market is a major consideration. Investors need to be sure they can lock up their money for the long haul and are prepared for the quarterly repurchase offer limitations. The risks, especially around leverage and liquidity, are clearly laid out and are substantial. The focus on performing credit while potentially high returning also carries inherent credit risk, especially in fluctuating economic conditions. The detailed expense structure, particularly for Class T shares, means investors need to carefully weigh those costs against any perceived benefits. Ultimately, this fund is for a sophisticated investor who understands and is willing to accept the risks associated with leveraged credit investments in an interval fund structure, valuing Oaktree as specialized management over immediate liquidity. Alright, that is our breakdown of Oaktree Diversified Income Fund Incorporated S Prospectus. What is your take on these numbers and what they signal for the company? S Future, drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.